I'm happy to be here. I'm always happy to be able to speak to my own chapter. I've done this once before. I did it in Princeton, South Jersey, when I was living down south of here. And it's always a pleasure to be here. I've been fortunate in my career to have both finance, in a 50-something year career, to have both finance, about half of it, and supply chain and manufacturing operations, the other half. So I've been able to be exposed to both. The interesting part about that is I have wandered around the business world for those 50 years, was as I talk to people in finance, they don't have a clue what's going on in operations. And the reverse is true. The people in operations and supply chain haven't got a clue what's going on in finance. It's not important that you know precisely what's going on in finance. It's understanding what the imperative of the business is. So if you look at that quote from Shakespeare, I didn't actually dig that up. I don't read that much Shakespeare anymore. That was for high school and college when they made you read that stuff. But my father-in-law was a financial executive, and when he got transferred, his team gave him a plaque, and they had this on it. So I found out it was Shakespeare. Wine maketh merry, but money answereth all things. And in the business world, nothing could be more true. So we're going to talk about about financial management, so that you all can get some background on this and get a feel for it. I'm not going to turn you into accountants or financial executives, but it's important to understand the imperatives. And that's why it's important. We're going to talk about that. We'll talk about how people in financial management think, and in fact, how senior management thinks. We'll talk about this. Rob mentioned some baseline concepts that you need to understand, and the microeconomics of the firm, and then a little bit on talking to your CFO, or at least being able to relate what you do to a financial executive's imperatives. And a financial executive's imperatives are almost always the same as the chief executive's imperatives. Now, he doesn't have to worry about marketing and engineering and operations, but they all have to worry about money. So we work here, we work in supply chain. I worked in supply chain and worked in operations. But as I was pointing out a moment ago, it's always about money. At the end of the day, it's always about money. We tend to get very wrapped up in what we do and start forgetting about where the money is and how what we do impacts the financial well-being of the company. So we don't always recognize that impact and don't always know how to relate it to people we're talking to. So it's important to be able to understand that. So here's what a financial executive thinks about. You can look at it on the screen. I'll just tell you a quick story. When I went to graduate school to get my MBA in finance, I think it was the very first course I took was a course called Corporation Financial Management. There were a whole bunch of other more detailed courses, but this was the first course. And there were a bunch of us. That was night school, and all of us were people who worked during the day. And the professor said, "Tell me," you asked for a show for people to raise their hand. He said, "What is the objective of financial management, and or what is the objective of management?" So, all these bright young guys, me included, I'm not sure how bright I was, but a bunch of us raised our hands, and you heard words like cash flow and profits, increased sales, all this other stuff. And he said, "No, that's not it." No one got it. What he said was the objective is to make the owners more wealthy. That's the objective. And again, here's a bunch of guys that were working, all had undergraduate degrees, had been working in the financial world, had never even thought of it. And when you sat back and after he said that, you thought to yourself, yeah, that's about it. That's what it's about. So when you buy a share of stock, you're an owner. What do you care about? Do you really care about the supply chain of General Electric? Or the manufacturing operations? No, you watch the stock price. And if it goes up, you become wealthier. And if the dividend is raised, you become wealthy. And that's what it's about. So what we do here has an impact on that. All we have to do is make sure we understand what the imperative is. So there are a bunch of things consistent with risk. That's a concept that that you don't have to spend too much time understanding, but recognize that decisions are made to increase shareholder value consistent with the risk of the corporation. So if you're running Apple, you take different kinds of risks. And if you're running Con Edison, you take an entirely different set of risks relative to what constitutes shareholder value. Buy a share of Con Ed stock, you're looking at a 4.5% dividend yield. That's what people want. People my age buy stocks like that. People your age buy Apple, which pays almost no dividend, and you hope that they'll do the right things and make the stock price go up. Completely different risk profile. So financial executives see these decisions in terms of cash flow, if you're Con Ed, or profitability, incremental profitability, if you are Apple. That's how the senior executives look at it. Because I've heard people in management tell me, when I was doing consulting, they would say, well, I'm not really very good with the numbers. And I never said it aloud, although I wanted to, was if you don't understand the numbers and you're a senior executive, then you don't belong in that job, because it's about money. And if you can't figure out the money, it doesn't matter how good you are as an engineer. At the end of the day, it's always about understanding why we're here. So here's what we're going to talk about in terms of financial concepts. I'll tell you about the fundamental theory of accounts, which doesn't need too much explanation, but it needs to be gone through. And we'll just run through basic balance sheet ideas, income statement, the three basic financial statements that people deal with. There are many more, but you don't have to know all about that stuff. People who are in finance need to know more about the details. And finally, some ratios that are important to the business and to the lesser degree, or to some degree, to supply chain people. So fundamental theory of accounts. It's the first thing they teach you in finance courses and accounting courses. Essentially, it is that assets of a corporation, that being cash, accounts receivable, machinery and equipment, and that sort of thing, the dollar value of that minus what companies owe equals the capital of the company. So, simply stated, if I'm not talking about a publicly owned company where you can buy a share of stock in the market. If I go and give the owner of a company $10,000 to buy a share of that company, again, this is not in the markets, this is directly to the owner. Assets go up by $10,000. Cash is assets. But shareholders' equity also goes up, because if assets have gone up and liabilities stay the same, subtract one from the other, capital goes up. That's the way it works. So companies increase their capital and their assets by making money. So if they make money, more assets will wind up in the corporation, which means more capital winds up in the corporation. So looking at the balance sheet, this is where you see the fundamental theory of accounts play out. Balance sheet presents assets, then it presents liabilities, and it presents capital. So we'll take a quick look at assets. There are basically two kinds of assets. There are current assets that will turn over within 1 year, and there are non-current assets or fixed assets which turn over multiple years. So, example, I guess I put them down there: cash, inventory, and accounts receivable. We as supply chain people certainly hope that inventory turns over liquidates in less than a year. Although I can tell you, I worked for a company, I won't tell you which one, where we had inventory that was there for a very long time. That if we weren't ordered to put it in the current assets part of the balance sheet, it would have been in the non-current assets. I don't know whether any of you have heard about the ways we value inventory, and I'm not going to bore you with that today, but you've heard of last in, first out, first in, first out. Have you ever heard of FISH? First in, still here. I worked for a company where we had a good part of our inventory was fish, and some of the companies I did consulting for, the inventory valuation was fish. So.
I've heard slow-moving obsolete.
That's slow-moving obsolete presents another unique problem. I can't get into that stuff here, but inventory valuation is a whole subject by itself. When it comes to liabilities, same categorization, current and non-current. Current liabilities, again, typically turnover within 1 year. Long-term liabilities or non-current liabilities turnover over a longer period of time. We who are in supply chain don't have to think too much about liabilities. We have to think about assets. We have to think about cash. We have to think about inventory. When it comes to liabilities, the only thing we have to really think about, even though we can't have a lot to do with it, is accounts payable. And we'll come to that a little bit as to why we have to think about that. Even though you're not paying the bills or looking at them, we have to think about it because there is some impact in this. And I was going to say as I go through this presentation, I would encourage you to spend some time with your friends in finance to talk about some of the things that you'll hear about tonight. So on the capital side, which now that you have assets minus liabilities equals this, equals capital. It's typically the common stock and the preferred stock of the company and the earnings that have been retained from making money. If you don't make money and you continually lose money, that can be a negative number. So if you're losing money, you're losing assets, which means when the equation where it plays out, less assets, same liabilities, less capital. So you can see companies with negative retained earnings. The company I was the CEO of, we had negative retained earnings. That's one of the reasons I was there, to see if we could fix that. But the bottom line was they'd lost so much money over the last 10 years or so that retained earnings was negative. It was essentially retained losses opposed to retained earnings. So we in supply chain, and I mentioned to you a moment ago, we can think about cash and inventory and accounts payable. It all comes out to working capital. Working capital of a company is represented by the current assets of the company minus the current liabilities. That's the working capital of a company. And that's the number that we want to make go up. I used to get, I have a stock presentation about lean manufacturing. And I would tell you, one of the ways that Henry Ford, when he organized his company back in the 20s, or when he was running it back in the 20s, Ford never had to go public until 1946. It was a privately held company. You imagine a company that size being owned by one family entirely until 1946. One of the reasons, and Ford did this intuitively, Ford was certainly not a financial guy, he was an engineer by training. What he did was when he sold his cars to dealerships, he got them to pay for the car in 15 days. He paid his suppliers in 30 days. And he had the inventory so low because he was only making one or two products. And everybody knows how fast he was able to run things through that River Rouge plant in Detroit. So his inventory was next to nothing. I wouldn't say next to nothing, but certainly low by the standards of the day. So he collected his money in 15 days, paid his suppliers in 30 days. Everybody was happy, probably except for the people who were paying in 15 days. So he had working capital all coming out his ears. And he didn't have to think about going to the public markets to get capital for all those years. And that's how he did it. People don't think about that. But the company was a very, very large company. Never went public until 1946, after the war. General Motors was public, Chrysler was public, American Motors, or what the companies that now turned into American Motors were all public companies. Ford was not, because he could do that. That's what working capital gets you. So, it's an important concept to keep in mind, because we don't pay the bills as supply chain people. We manage the inventory, which Ford managed very well, and we can't certainly have too much influence on how money is collected through receivables. but it's important to know these things. So, Ford, of course, made a lot of money, too. I mean, it was a very successful corporation. And, I'll just run through the basics of the income statement with you. Pretty intuitive. An income statement is basically the revenue of the corporation, which is, pretty self-explanatory. If you're just thinking about cars, it's the cars they sell. And the income statement, or P&L of a company, typically breaks down into 3 sections. With some amount of detail, we don't have to go into all that detail now. Cost of sales being the first one, and that's the cost that is directly involved in making the product or service that you sell, that can be identified to the sale. The general and administrative costs are the costs of running the business, the management, the supply chain departments, all that sort of thing that are not directly related. The directly related are typically materials in manufacturing and supply chain. And financial cost is typically the cost of interest. And almost all companies have some debt. If they have a balance sheet with long-term liabilities, they have debt, they have interest. And then there's income taxes and other stuff that comes out to the bottom line. So that's what that looks like. A cash flow statement. There are 3 levels of a cash flow statement. The first one, and I'm not going to spend too much time on it for you, is operating cash flow, which is essentially net income of the company. Hopefully it's income. Plus, anything that's included in the computation of net income that doesn't involve the outlay of cash in that year. So it's typically depreciation. The depreciation that's charged from the assets, the fixed assets, so the machinery of the company. So every year, the value of the machinery is written down, or the fixed assets is written down, and a charge is taken against income. That's not recognized as cash in the current year. So cash flow, operating cash flow, is typically income plus non-cash charges, such as depreciation and any other kind of amortization, plus changes in net working capital, plus or minus net changes. So if your inventory goes up, what happens to cash flow? Goes down. So when we manage the inventory, we have an absolute effect on cash flow. So from year to year, if inventory goes up, cash flow goes down. If we bring inventory down, cash flow goes up. Same with accounts receivable. They start collecting the money faster or slower, depending if it goes up or down. So those working capital accounts have that impact. Then that brings you to a cash flow from operations. The next level of cash flow is operating cash flow, or cash flow from operations, that brings you to cash flow after investments. This is where now money gets spent, typically on assets, capital assets, not inventory or accounts receivable assets. The next level is capital assets and any investments in long-term financial assets. Many CFOs buy long-term bonds with the excess cash of the company, so that it reduces the cash flow that's available. That's that level of cash flow. After that is subtracted the next level, or added or subtracted the next level of cash flow, which is cash flow after investments. And this is where, after investing activities, I think they call it, it's the technical word, is if you issue stock, cash has increased. Issue debt, cash has increased. Pay dividends, it's decreased. Pay down debt, or buy your own stock, it's decreased. So, ratios. Ratios are important to supply chain people. That stuff is important to keep in mind. But we live in a ratio world, and there are liquidity ratios that we talk about. These two here, the current ratio and the quick ratio, talk to the ability of the corporation to meet its obligations as they come due. So for many, many years, certainly in the years I was growing up in finance, a current ratio of more than 1 was thought to be good. More than 1, like 1.5. So if there were 1.5 times assets, current assets, relative to liabilities. So if there was $1.50 of assets for every dollar of liabilities, that was thought to be good. The quick ratio, which is an even better measure of liquidity, takes inventory out of that. Takes inventory out of the asset side because it doesn't move so fast, and particularly back then it didn't move so fast. I started working in the 1960s, the early 1960s. No one paid attention to inventory. It was all over the place.
Jerry, I took a finance course and we looked at also the debt to equity
Yep.
ratio. What is that?
I'll tell you, one of my former colleagues used to say, there are no dumb questions. There are excellent questions, and there are most excellent questions. That's an excellent question. A most excellent question is that the answer is on the next slide. An excellent question is what we have a slide for. So, since it's not on the next slide, it only qualifies as an excellent question.
I'm ahead, sorry.
That's okay. That's no dumb questions, only excellent and most excellent. So these are the liquidity ratios they talk to. They deal with the ability to pay bills. The quick ratio is a better one. Way back when it was thought if that was 1 or slightly less or slightly more, that would be good. These are now more like current ratio of 1 is fine, quick ratio of 0.5 is fine, because we turn inventory faster in the case of current assets. And typically cash flows are recognized as being stronger, so the quick ratio doesn't have to be quite as high. But if you're looking to make sure that people can pay bills, look at the quick ratio. Here's the ones we deal in. The efficiency ratios. Inventory turnover and, inventory turnover. We're going to talk about receivable turnover in a minute. Everybody understand inventory turnover? Does anybody know what their company's inventory turns are? You ought to know. You just ought to know. It's not that complicated. If you have access to the financial statements, if it's a publicly held company, just look at the financial statements online, or you bring up the SEC reports. It's essentially, you divide inventory into cost of sales and you get turns. When I started working, a turn of 2 would have been the normal. 6-month supply. This is the early 60s, you understand. No one even thought about lean. MRP hadn't been invented. So inventory was managed by order points. It was sort of a ridiculous system, but no one knew any better. The manufacturing paradigm was pile up a bunch of raw materials on this side, pile up a bunch of finished goods on this side, and then optimize the speed and the efficiency with which you made things. And it didn't matter how much inventory you had on either side, but you always had inventory, so you never ran out of anything. But the inventory turns of 2 were what they did. We are lucky nowadays to get inventory turns of 6 and 7 and 8 in a lot of companies. I can tell you, Toyota's in the 20s.
Wow.
Toyota's, they invented lean. Japanese don't think inventory should even be called an asset. They think it should be called a liability. It would sort of screw up the fundamental theory of accounts if they did that. But their attitude is inventory is an evil. And so they just continually work at keeping it low. They had gotten the thing up to 25, 2-week supply in an automobile company. It's amazing. Now Ford was close. No, I don't think Ford was quite that close back in the 20s, but that's the deal. So, and you can express it as days or weeks of inventory by essentially converting cost of sales into a daily number and dividing it into.
Dell. What Dell computer?
Well, Dell does a very good job. Dell is among the best in the supply chain. If you look how I think what Dell has done, I know what Dell has done. The fact is Dell has essentially, figured out the assembled to order model based on forecasting. And they forecast to a very high level rather than a very low level. And they manage the flow of parts rather than, so they may forecast finished goods, but when they buy materials, they buy fungible generic materials. So have you ever bought a Dell computer on the phone?
Yeah. That's custom built.
The guy, you can hear him clicking.
Right.
He's assembling your order from parts. So they forecast it to the parts, they forecast to the parts level. And that way then they assemble the order. And they can keep those parts moving really quickly. And you get I don't know how the hell they do it. Last Dell computer I bought said it was made in Malaysia. I got the thing in a week. And I thought it would take a week just to get it on a boat. Not to speak of putting it together. I still can't figure out how they did that.
A lot of them do postponement closer to the point of sale.
Right, so the computer's made in Malaysia, sent here, and then they finish it.
Yeah, then it's finished.
Well, there's semi-finished and
Right.
stuff like that.
Right.
They don't do a lot of that. It's mostly parts. That's how they keep the turns going. So go take a look at your company's financial statements.
Isn't it? They don't really get a bill from the supplier until they assemble it into a computer.
Well, that is a working capital implication. I didn't know that about Dell. That has a working capital implication, because if you're paying the bills much later,
Yeah, because they're
the cash flow changes
getting it
quickly.
from the customer before you pay the supplier.
Well, that's what Ford was doing, essentially. I didn't know Dell could pull that off, but a lot of companies are trying to. We're going to get to that in a minute, because another one of the turnover ratios is accounts payable turns. Receivable turns are similar, except you use sales and accounts receivable as the numerator and the denominator when you're calculating this. So again, this is something you ought to, if you can't look at your company's financial statements, wander over to the financial department and ask them. They'll probably tell you, unless there's some big secret. Some privately owned companies don't like to discuss their financial matters, but I don't think you'd have too much trouble normally. And that again is a big component. So if you look at a day's sales outstanding in receivables, or say a turn of 6 means what? You collect your receivables in 60 days. It's like the reciprocal of day sales outstanding. Good companies, better companies get their receivables faster. Depends on your terms, depends on who your customers, are, and whether you can beat them on the head enough to get them
on time. Whether they pay on time.
Well, or you beat them on the head till they pay on time, or you have leverage on them.
Yeah.
I was the CFO of a company that sold hotel amenities. When I got to be the CFO, the stuff you find, the soap and all that stuff, they'll tell you something. You can't open a hotel room without that stuff in this day and age. And they don't have room for inventory. So all the rooms are used for, people paying. So they kept very low inventories. I got to be the CFO. Our day sales outstanding were 90. Our terms were 30. So what we did, since we had leverage on them, we said, you don't pay us, we don't ship. We don't ship, you can't open the hotel. Receivables came down to 40 days within 3 or 4 months.
Wow.
Because we told them, you don't pay, we don't ship. We put you on hold immediately. And everybody said, well, that's, a hell of a way to do customer relations. But I wrote a chapter in the book on accounts receivable for that big firm I was with. And one of the things I learned was, when you ship the product, you have more right to the money than they do.
Yeah.
And that's what you have to understand.
That's what you invoice. That's what you invoice.
Yeah. And once they've got the goods, the money they owe is more yours than theirs. So when people said, well, that's a pretty rough way to deal with these people, the answer is, you don't want to pay me? Not shipping. Now, you can't always do that, because we had exclusive contracts with their logos and all that other stuff. And the ability to change suppliers was really tough. It would take them 6 or 8 weeks. And then if they didn't get amenities, they couldn't open hotel rooms. So it was a big difference. Now you come to payables turnover. This has become a problem. We deal with Merck. This chapter deals with Merck. And, we sell them books for courses. We buy the books from the APICS supplier, and then we essentially sell them to Merck. It's sort of, we're passing it through, and there's a whole bunch of reasons for that, which I won't bore you with. But the fact is, Merck's practice is to pay in 90 days. So they're optimizing payables turnover by doing this. Now, as supply chain people, I would tell you, I'm not sure how much influence you can have on how bills are paid in your company. That's a crappy way to run a railroad. I mean, it doesn't matter. Financial people think they're getting something. You get free financing. You're basically using your suppliers as a bank. The trouble is, as one guy who ran a division in a company I worked for once, he said, I pay my bills in 15 days, and the financial people were all upset with him. He said, when I need something at 3 o'clock in the morning, I can call up the supplier. He'll go to his plant and make sure it's shipped that morning. If I stretch them to 45 days, the answer will be, don't call me at home. It's a big difference. Supplier relationships in the era of lean are important. You screw your suppliers and then say, well, we have a nice lean management system here. Doesn't work because supplier partnerships are what we do now. When I started working in the 1960s, it was, see how badly you could screw the supplier. So you have to play them against one another, beat them on the head, pay them when you feel like paying them, and then you got lousy quality, poor delivery, you know. But again, if you had tons of inventory, it didn't matter. Just keep buying the inventory, you had a whole bunch of raw materials, who cared? Supply chain back then was hardly a supply chain. It was like arterial sclerosis, it was clogged on both ends. But the payables turnover thing is a difficult number. You might ask somebody to calculate it. Not every financial department calculates it, but it's an interesting number to know about. And this is what Jim asked about, long-term health. You know, long-term health ratios, the main one is the leverage ratio. And use this simple calculation. You divide the shareholders' equity section or the capital section of the balance sheet by, the total assets section of the balance sheet, you divide by the shareholders' equity section. And that tells you how many dollars of debt you have for every dollar of equity.
Example.
And that can be good. What's that?
Example.
Yeah, I know, I'm trying to think of one. I mean, I'm trying to put it into numbers. Well, I'm trying to put it into numbers. If your total assets are, I'm just going to take a simple number, $100. $100 million, $100, doesn't matter. $100, and the portion of that's represented by shareholders' equity is $25. You divide 25 into 100. What you have is $4 of debt for every dollar of equity. So you have a leverage ratio of 4. Now that can be good or bad. I can't tell you whether it's going to be good or bad. If you're a utility company with a stable cash flow and a stable business that doesn't jump around like other companies do, you can have a high leverage ratio. If you look at the balance sheet of Con Ed or Southern Company or California, Pacific Power and Light or any of them, what you'll see is a lot of debt. You'll see high leverage ratios, higher, because they have stable income, they have stable revenue flows, stable cash flows, they can pay down this debt. They're not in danger of defaulting. But if you're in a business that jumps around and you run debt up like that and things go the wrong way, then you can't meet your debt. Macys did that about 15, 20 years ago. And you may remember, Macys went into bankruptcy. And, you know, they made the classic chief financial officer mistake. They said, let's leverage up. We can make more money on other people's money by borrowing money, blah, blah, blah. The trouble is the retail business isn't that like predictable. You have to be able to call the turn on fashions, all this stuff. And you make a mistake, which any retailer can do, and you get that kind of debt. And that's what happened. They didn't call the turn right on fashions. They didn't know that pink jackets were in. And, you know, they lost sales, couldn't make the debt. They had to file for bankruptcy. They came out of it, fortunately, but that's what happened. So that's what the leverage ratio tells you. And, you know, you look at it from different points of view. I mean, Ben is with Verizon. Verizon is a very stable, revenue-based company. I mean, I own Verizon stock. Lots of people own Verizon stock. It's not highly leveraged, interestingly enough, but they could be.
Is this Verizon or Verizon Wireless?
Well, I look at the total company because you can't get the numbers. You can't get the numbers separated on them. They don't separate those numbers because they're not about to tell AT&T how they're doing on each of the segments of their business, or the other, telecom companies. So
But you would argue that Verizon Wireless would have a lot more debt than
it could.
Verizon.
Well,
The land-
I don't know about that. I'm not sure. I don't know exactly how Verizon's business is run. As a shareholder, at my age and my interest is the dividend. You get to be 75 years old, you stop thinking about growth, because you're going to be dead by the time the growth happens. I mean, that's a fact. I could live quite a while, and the growth is going to be irrelevant. Growth is for people you guys' age, where when you get to be 65 or 70 years old, the money's grown enough so that then you can invest it in things like Verizon and get the dividends. So I look at certain parameters to make sure the dividend is safe. I don't much care. I'm not worried about Verizon's management. But they can have more debt. I also own utility companies, stocks. They have loads of debt. Because they make good money on the debt.
Real estate too, right?
Well, real estate's another thing, because real estate jumps up and down. But it depends what real estate you're in. This is not a course in securities analysis, but we can talk about that after the meeting if you want. But so anyway, those are the ratios. Think about turns of payables and inventory in your life. Recognize that the other ones are there, but think about them. So, how does a firm make money? I started my career as a cost accountant in 1962. And over the years, what I've learned about firm microeconomics and about cost accounting is that what I was doing in 1962 through maybe 1968 or thereabouts wasn't really worth doing. I mean, I was able to make a living at it. As a consultant, I told some people how to do it. But I realized that what I had learned, or what I had been practicing, really wasn't too terribly important because it didn't reflect the microeconomics of a company. What we had done was we'd done a bunch of accounting and arithmetic tricks with costs, which obscured or obfuscated is a better word, the real economics. So we'll just take a quick look. Well, where was I here? Okay. We're going to talk about four things. Fixed and variable costs, important to know in firm microeconomics. Talk about a couple of accounting concepts, cost accounting concepts. And we'll finish up with cost volume profit analysis or delta analysis. Variable and fixed costs are important to know. So if I ask you, if you studied accounting when I studied accounting back in the early 60s, if I asked you what a variable cost was, what would you say in manufacturing? Materials?
Right.
Yeah, materials.
Yeah.
Can't sell something without the materials to make it. What else?
Well, the distribution, it'd be the number of shipments going out.
The labor?
Well, but see, Cal brings up labor, Jim brings up distribution costs. Distribution costs are variable. Typically, if you're shipping by truck, you can probably get a variable equation. Every pound costs a certain amount of money, assuming that there's not a fixed charge in the truck. You're shipping LTL, you can get some differences. But people thought labor was variable, but it's not. I was brought up to believe labor was variable. It's not. Even it may have been variable at the turn of the 20th century, the previous century, when the 19th turned into the 20th. But we do things with machines now. So a person can be at a machine in the pharmaceutical industry or any other industry. They can be at a machine, and they're running a machine. It doesn't matter how much that machine puts out, they still have to be there. So they become a fixed cost. So back in the early 60s, people used to say to me as a young cost accountant, the old guys would say, listen kid, labor is variable and utilities is fixed. It's the other way around. Run machines. When they don't run, you turn them off when the electricity stops. It's really variable. but the labor is still there. You can't lay people off like you could in the docks. No work, send them home after 4 hours. Can't do that. You could do that at the turn of the previous century. Can't do that anymore. So labor isn't a variable cost. It's a fixed cost. So we've been wandering around under this delusion that labor is variable. It's not. You can look at a lot of things. Salesmen's commissions are variable if you're paying people on sales, on sales dollars or sales units. Yeah, every sale generates another dollar or so amount of commissions. Utilities can be turned off when the machine turns off. At least that part of it. The part that lights the building is almost not noticeable compared to running big machines. So labor is really not variable. You staff up to a point, and then you have labor. I mean, it can go down if you have a dramatic decrease, but if your business goes down 3 or 4%, the labor doesn't go down, but materials does. Go down 3%, 3% less materials. Go down 3%, labor's the same. Go down 20%, you might lay some people off. But that's in plateaus. It's not curvilinear. And curvilinear is what defines variable. So, variable is typically managed in the short term, and fixed are thought to be in the long term. And we'll talk about marginal income decisions in a little bit. So, I've spoken a little bit about it, up to now. They vary in direct proportion. An old term we used to use is the cost of doing business. And when you look at the bottom bullet, when you subtract variable costs from revenue, you get what accountants call contribution margin. What did Ellie Goldratt call that? Everybody read the goal?
Wait,
What did Goldratt call revenue minus variable costs? Well, I'm not sure he articulated it very well in the goal, but in the book, The Theory of Constraints, he did. It's called throughput. He called it throughput. I mean, it's probably a misleading term, but Goldratt being Goldratt, he was the smartest guy I ever met when it came to manufacturing, because I met the guy and spent some time with him. He's a smart guy, he just had his own way of doing things. He called it throughput. So when you think about the theory of constraints, it's the same as contribution margin. Throughput is the same thing. But that's a big important thing to understand, because contribution margin or throughput covers the fixed costs. You have to have enough of that to get past the fixed costs and contribute some profit. Ellie Goldratt called fixed costs OE, as he put it, operating expense. Anything that wasn't variable, as far as he was concerned, was operating expense. And so, we'll talk about that in a minute. So that's important to remember. It's important to think about what Goldratt said. It's about the variable costs and the contribution they make to covering the fixed cost and giving you a profit. Fixed cost, sometimes called the cost of being in business, which is a good way of talking about it. This is what Goldratt called OE. And what General Electric calls readiness to serve, which is my favorite way of describing it. In General Electric, they do things right when it comes to managing the microeconomics of GE. I don't know about GE Capital, but the industrial...
Capital.
Yeah, I know. But that's a bank, and I don't know any
Well,
of
the
it.
cost of money is zero or something.
Yeah, I mean, that's a whole other story. But the industrial sides of General Electric that typically manufacture and or distribute things, they talk about readiness to serve. Fixed costs, that being anything that's not variable, what Ellie Goldratt would call operating expense, they call readiness to serve. I like that term, because what they're saying is, if we decided to be in this business, or a business, whatever it is, we are now ready to serve by putting this infrastructure in place of people, buildings, machinery, and all this other stuff. Now what do we do with all that stuff is we get throughput or contribution margin to cover that, to get more contribution margin than the readiness to serve costs. So it's important to think about these things this way, because General Electric's got it right. And the fact was, when I was a young cost accountant, we had it wrong, and I'll tell you why in a few minutes. Because the bottom bullet it tells you a lot about that. What we do in cost accounting is we take all these fixed costs, this readiness to serve, or what Ellie would call operating expense, and unitize it. so we can get what's called a full cost, which is an enormous fiction. Because what we're doing is we're saying, well, this readiness to serve cost, which doesn't change much at all over the volume of the business, we divide it by some proxy for volume of the business, whether it's units or labor cost or machine hours or anything like that, and we add that to the variable cost and say that's a full cost. Well, that's all very interesting. So people now think that the unit profit now includes this allocation of this readiness to serve costs on a unit basis. It might come out to a cost that's more than the revenue you can generate from that product. And people will say, it's not profitable, don't do it. What they're doing is they're foregoing the contribution margin or the throughput. Because what somebody has said was, well, if I add this 50 cents or extra dollar or so to the unit product cost, it makes, and we can't sell it for more than that, we're losing money. We're not losing money. Because we're selling it for more than the variable cost. And the fixed cost doesn't change no matter whether we sell it or we don't sell it. That was the cost accounting I was taught. I kept doing it, and I kept doing it, and I kept doing it, and I kept thinking to myself, something's wrong here. I just couldn't figure it out. It took me about 6 or 7 years to really come to the conclusion. And I'd like to believe I was ahead of Ellie Goldratt, but I really wasn't. As they said, he was smarter than I was, certainly. So traditional cost accounting did that. It unitized fixed costs. Everybody understood what variable cost was, although they thought labor was variable, which it isn't. And unless they're in certain kinds of industries where you can simply treat people like they used to on the docks. You come in and work 2 hours and there's nothing left to do, they send you home. You can't do that anymore, thank God. So they stipulate for the variable cost, and then they add a unitized fixed cost to it, which is what I was just telling you about. So unitization is the fixed cost is a quotient of the fixed cost divided by some proxy for volume. And it makes them look variable. So people will say, well, volume goes down, cost should go down. Only the variable cost goes down, the fixed cost stays. And that's the misleading part of this. That's what traditional cost accounting did. See that formula up there? The guy who raised me to become a partner in that big accounting firm, he was a pretty interesting guy. He came up with this formula for an allocation. It's intended to be humorous. NN divided by DD equals QQ. And this is going to take some imagination to come up with this. I couldn't figure out what the hell he was talking about when he first showed it to me. It stands for nebulous numerator divided by doubtful denominator equals a querulous quotient. And if any of you have ever hung around accounting or even supply chain or manufacturing operations, when you start doing allocations, what you get is arguments.
Yeah.
It shouldn't be this denominator, it should be that denominator. It should be, this cost shouldn't be in there. It's just one big argument. And he was right. It's a querulous quotient. All you do is argue about the arithmetic and the allocations. It's the stupidest way to... And that's what traditional cost accounting did to us. Now, I've written articles on this, and people who believed in this stuff would send me emails accusing me of being a communist, almost, because I advocated this. Hate mail. I would get this hate mail. I didn't get that much of it, but there were some people who felt pretty strongly about this stuff. So we've graduated past that. We'll just go back from that. And that's it. I talked, what Goldratt calls it is cost thinking. What we're doing is sitting around moving costs around the chessboard instead of throughput thinking, which is how do we maximize or optimize the amount of revenue minus the variable costs that we get. We spend our time on that rather than this ridiculous arithmetic. We get somewhere. So then came along activity-based costing, which some people turned into a variation on the traditional cost accounting by essentially making a finer breakdown or finer unitization of the fixed costs. But basically, it recognizes the variable costs as variable. And then what it does is it doesn't unitize fixed costs if it's done right. What it does is deals with them at the product line level in aggregates. And that's the secret to understanding different parts of the business. It's the aggregation level. It's lines of business. It's not products. So if you work for a company like BASF or Bayer, which has thousands of products, instead of looking at the unit, instead of looking at the fixed cost as a unit basis for each product, which gets you all this confusion, activity-based costing says, well, let's take the product lines. So BASF, who Carol works for, might have thousands of products, but might only have 6 lines. And what activity-based costing is doing is it's taking those costs that cut across all those lines and trying to assign them to lines and leaving them there as a fixed cost, not unitizing it. The mistake a lot of people made when this was originally conceived of was they said, oh boy, this is a better way to do unit fixed costs. We're just like, oh God, help us. It's just another level of ridiculous arithmetic. But this puts it in the right place. So even something like Verizon Wireless, which has a bunch of divisions, thousands of services and products, same idea. The idea is to identify anything that's common to all and put it into the right column and leave it there as a fixed cost to be covered by what Ellie would call throughput, or contribution margin. So when they do it right, it's done by product lines, it's done in aggregate, and they come up with numerical measures of activity. I'll tell you, one of my favorite examples of this was when I was at KPMG, we were doing a cost accounting and cost analysis study for a pharmaceutical company. Can't tell you who it is, but it wasn't very big. It was one of the ones that made generics. And they still had to have a laboratory and had to have all this other stuff. And they allocated the cost of the laboratory, which was common to 3 product lines. They had 3 product lines. They allocated the cost of the laboratory based on the number of units sold. So they basically made analgesics type of thing, aspirin, ibuprofen, which they sold to the people who branded. They also had a vitamin line, and they also had a Valium line. They made Valium because it was by then generic, and they made Valium. So the laboratory did testing. The biggest seller was analgesics, and so it got most of the laboratory cost. The one that was the lowest number of volume was Valium. So it got the least amount of the laboratory costs. What do you think they were doing most of the testing on?
On the value.
Value.
That's right. So what they were saying was Valium gets less of that laboratory attached to that product line, and analgesics gets more because it sells more. It doesn't use the activity of the laboratory more. It uses, so when we got there, we said, what's the relevant activity to put the laboratory into the right column of those 3 product lines? It wasn't very hard to figure out. Laboratory tests. What were you spending your time on? What were you doing tests on? So there was a laboratory of 20 people or whatever it was. What we did was figure out by their own records, because they had to keep records of the quality department. There was the laboratory department. We just looked at it, and the next thing you knew, Valium was getting more. Valium looked very, very profitable. Analgesics didn't look so profitable. But the bottom line was, if you sliced off Valium, you'd probably lay off 3/4 of the laboratory. And that's the relevant way of understanding it. That's also been called by me and others divestiture analysis. You want to understand where a fixed cost goes. Ask yourself the question, what would happen if we got rid of this entire business? So in that case, if they got rid of Valium, 3/4 of the lab would go away because they couldn't possibly keep them busy. If they got rid of analgesics, they would have lost a lot less of the laboratory. So that's the way to understand it. It's a decremental analysis, if you want to call it that, or a divestiture look. So That's how you can make activity-based costing work right. Now, I'm just going to show you, this is a little complicated, and I don't like to do this kind of slide, because Harvey McChesney, who is the APICS expert on slide presentations, if he saw me doing this, would probably come, if he was in the audience, he'd probably come up and drag me out of the room, because his rule is you never show numbers like this, it's too confusing. But I wanted to do it anyway, because this is a way of looking at those two products, just like I described for that pharmaceutical company. I chose a food company. You can look at the variable costs, which are displaceable, and that's another word for divestiture or decremental. They're displaceable. Product line A, institutional products, goes away, all that goes away. You go down a level, and you brought these costs into line here, into the columns. You've got a margin or a throughput number here. Then you've got a bunch of costs that relate to that product line that are displaceable. So if you got rid of that product line, all this would go away. And similarly with product line, with retail and all that stuff. So here's your margin over displaceable costs. So you've got two levels of margin. Now we go over that's throughput margin. Then you've got a margin over displaceable costs. So now you know whether that business makes money for real or not. It's like a standalone business. When you get down here, what you're saying is I want to assign some costs and ask this to cover this. These would not displace. So if you got rid of this would stay. So it creates a bit of a problem. But if you want to say, well, we're going to ask this division to cover a certain amount of the core corporate costs, we'll just allocate them over based on different criteria. Like occupancy, everybody knows what occupancy is done on. It's done in square footage. So, but that's the way that intelligent look at firm microeconomics and activity-based costing looks like. So when you think about that as a supply chain professional, thinking about firm microeconomics, it's just important to know these things. So when somebody talks to you about a total cost or stuff like that, maybe you can't affect it. It's important to just know it. We don't always, in supply chain, don't always have an opportunity to make things happen. But, as you grow in your careers and become executives, and you remember some of this stuff and how companies make money, you'll manage the supply chain to a better level of profitability by having this kind of knowledge.
So on that chart there, I just want to make sure I understand something. So those assigned non-variable costs,
Yeah,
even if you got rid of that product line,
they would stay.
they would stay, so they would shift over to the
That's
other
right. They would
product.
technically. Didn't move it back. Oops, wrong one. They would have to be covered by this.
Right.
So if 360 million, whatever it is, moves over here, now they've got, 790,000 to cover. And what they've done is they've forced this into non-profitability. And of course, this number reflects this number at that point. So it's not profitable. Then you get some costs that you don't allocate, and you're really screwed. But if you understand it that way, then you understand it. Because all we're saying is this is what we're asking them to cover while we still have it. We don't have it, this stays. This all may go away, but this stays. And it moves over to here, then changes the whole equation. Well, actually, it doesn't turn it into a loss. It turns it into another, this goes down by $360,000, and this goes down by $360,000. And this we've chosen not to allocate. But we used to, when we talked about that to people, they'd say, what's a core corporate cost? We'd say the receptionist. How do you allocate the receptionist? There were people that actually, believe me, this is how moronic this can get. People would say, well, we can allocate that to product lines based on the number of phone calls that go to a certain, it's like, that's precise. Oh, God, go away, leave me alone.
Fire.
That's right. But Ben's point is a good one. Some stay, some leave.
All right.
Plus volume profit analysis, break-even analysis. A couple words on that, and we'll just, we can do some questions if you want, or we can stick around after the meeting. Simple formula for break-even. Fixed cost divided by throughput. Valley Goldrat's throughput number, unit contribution margin. The simplest example of this is a restaurant. Even though, we're not in the restaurants aren't typically in the supply chain business unless you're running a huge chain. But if you want to open a restaurant, almost all the cost is the building and the waiters and and the fixed assets and the dishes and all that other garbage that comes with it. And you have to get a certain number of sales dollars before you break even. It's a very simple thing to think about, because even the food to some degree is fixed, because you buy it on forecast. How many hamburgers do we think we're going to sell next week? We buy that much meat. How much chicken do we need, or whatever it is. So it's typical that way. We typically express this in terms of charts. This is fixed costs and this is throughput. There's the break even. So between there and there is loss. And after that, what happens is, absent any change in fixed cost, this number just gets bigger and bigger and bigger and bigger. You change the break-even point. So if it moves from here to here, it takes you longer to get to this number. It's always one of our favorite ways of doing this is to express it in charts. Similarly, if you change the contribution margin number, it moves over again. So it takes you longer to get to the profit side. And it'll take you longer, it won't grow as fast. So. When you talk to the financial people, whether it's the financial executive or somebody in the department, again, we spend too much time on two sides of the fence. They think we're spending all the money and wasting it, and we think they're just doing nothing but counting the beans. And I can tell you, there was a gentleman here in APICS in the Central Jersey chapter by the name of Don Frank. Gary and I know him. Some others might remember him. He passed away a number of years ago, but I was doing a presentation on cost accounting once. And Don was kind of a curmudgeonly soul, to say the least.
Oh, yeah.
So he says to me in the question and answer period, with his gravelly voice, he says, "When are you bean counters going to understand what we do?" And I was trying to make Don understand that it isn't beans we count, it's money. And if you remember the name of the book, what was the name of the book that Goldrat became famous for? The Goal. What was the goal?
Money.
To make money. Poor Alex Rogo, the dopey plant manager, didn't figure that out. And his mentor, Jonah, which was really Ellie, that was Ellie's alter ego. Ellie had a very big ego. His mentor kept saying to him, Alex would describe this wonderful machine he got that would bat parts out like there was no tomorrow. And his mentor, Jonah, would keep saying to him, "But Alex, are you making any more money?" And he kept saying, "But you don't understand. You see, this machine bats these parts out like you wouldn't believe. Take a look at this thing." And he kept saying, "Alex, are you making any more money?" So it ain't the beans, it's the money. And we're all in the same, we're all in the same boat here. Making money is what we're supposed to do. There was a saying going around APICS 10 years ago. Went like this: what do we sell? Capacity. What do we make? Money. And it's true. You build a factory or a warehouse or a business, you've got to sell it. The best example of that is an airplane. The guy who was the chairman of the board of American Airlines, a guy named Bob Crandall, who happened to come up through finance. And I never liked, I didn't know him, but you see him on television, he was always complaining about how rough it was to run American Airlines and all the rest. But he made a good point. He said, when I buy an airplane, I make $1 billion bet, because that's what one of those things costs. I make $1 billion bet that I can fill it up. Well, that same could be said about lots of companies. Open a restaurant, you make a bet that you can fill it up. Open a factory, make a bet that you can fill it up. And that's what it's about. It's about filling it up and making the money. So they're not the enemy. They're charged with, making sure that the shareholders' wealth increases, and that all the decisions that the company make essentially contribute value. So when you think about this, when you're presenting things or thinking about decisions you make, it's important to remember and to be able to relate to these people that you can show the financial impact that's real. And if they have a traditional cost accounting system, you can essentially compute contribution margin by just picking out the variable part of it and making sure you got the right variable part, mainly materials, because a lot of them still think labor's variable. And the dollar return, the best way to do that, I think, for most people is just to show payback. It's unsophisticated. Those of us who went to MBA school think we have to do discounted cash flow and net present value, all that stuff, but still, payback is fine. I worked for a company years ago, the chairman of the board, if you brought him an investment proposal, he demanded a payback of 2 years. And you have to know this guy to know what he was doing, because he thought everybody was a bullshit artist. And so what he said was, if you tell me it's 4 years, it's probably going to really be 8. So if you come in here with 4 years, I'll kick you out and demand that you come back and tell me you can do it in 2. So maybe you'll do it in 4, and I'll be happy. I think that was his style, because he was a very, very difficult man, and he tended not to believe anybody about anything. But payback's a simple way to think about something. If you're thinking about doing something that involves purchase of an asset, you need to think about the payback and be able to, when you're discussing it with a financial executive, you might even want to find out what the financial department requires for a payback. It wasn't very difficult in that company. Everybody knew what the boss wanted. And you didn't dare walk in there with anything less. And I got to tell you, people walked in there with 2 paybacks, 2-year paybacks. He never got 2-year paybacks. And I think he knew that. We might have got 4 or 5, and then he knew he was having. Came in with 5, he figured you were going to come in with 10, and he didn't want that. So you might find out what their hurdle rate is. So that's the presentation.